Silver has already crossed into a zone where the paper market loses control, and the next squeeze happens fast. There's a reason you're seeing people suddenly talk like this. Move is too far, too fast. And it's not because they care about you buying the top. It's because once silver starts repricing on availability instead of opinion, the old playbook stops working. The force trying to suppress this story isn't some cartoon villain, it's the structure itself. Futures liquidity, tight risk limits at banks, and a whole ecosystem that needs silver to behave like a tame, mean reverting asset so spreads stay stable and hedges stay cheap. But the hidden mechanism the mainstream keeps missing is simple and brutal. When the deliverable pool gets thin, the spread becomes the truth and price has to follow. Stay with me, because in a few minutes, I'm going to give you a clean checklist for the next week or two. What levels matter? What confirms the stress? What invalidates it? And what breaks first if the market tries to calm down by smashing the tape? Here's the part that most people get wrong right at the start. They look at a big number on a chart and assume it's emotion. It's not. Silver doesn't move like this because everybody collectively got excited. It moves like this when somebody who needs metal can't get comfortable with the timeline, and somebody who's short paper can't afford the volatility. And those two things together create forced behavior, not opinions. You can see it in the way price is closing, not just in the intraday spikes. When a market starts closing strong, then reopening strong, then refusing to give you those easy dip buying entries that should show up after a run, that's the signature of participants being pulled forward in time. They're not buying because they love the price. They're buying because they don't like the risk of waiting. And that's where the real pressure starts. Because silver is one of those markets where the calm can last for years, and then the repricing happens in weeks. And the reason is that the underlying plumbing doesn't expand on demand. If you're looking for a clean current anchor, silver has been hovering in the mid-90s per ounce range after recently tagging fresh record territory above the low 90s. And it was already up sharply early in 2026 after an explosive 2025. That kind of momentum gets headlines, sure, but headlines don't move the metal. Flows do, spreads do, margin does. And that's not the part that matters. The part that matters is why this is happening now instead of last year or next year or someday. The calendar is the catalyst. Markets can pretend constraints are theoretical right up until the calendar forces delivery choices, option hedges, month-end positioning, and roll decisions to happen on schedule. Then it turns from a story into math. This move isn't emotion, it's math. Let me hand you the mental model that makes all of this click. Silver trades in two worlds at once. One world is paper, futures, options, swaps, synthetic exposure, ETFs that can be created and redeemed, all designed to let you take a view without touching a bar. The other world is physical. Bars that meet exchange specs, vault logistics refiners, wholesalers, industrial procurement, and the reality that a lot of silver supply is not actually sitting around waiting to be sold at today PASEC OS price. In normal times, paper price leads and physical follows. In stress, physical reality starts leading and paper has to catch up. And when that happens, you don't get a smooth staircase. You get a lurch. Because if this one level breaks, the math changes. Now here's the hidden detail that reframes the entire story. And it is the one thing I want you to tattoo on your brain. On the COMEX, not all inventory is equal. People love posting total stock numbers like that's a reservoir anyone can drink from. It's not. There's eligible metal and there's registered metal. Eligible means it meets the standards and sits in an approved warehouse, but it is not necessarily available for delivery because it is owned by someone who has not put it up for that purpose. Registered is the subset that is actually warranted and available to deliver against futures contracts. That sounds like a boring technicality until you realize what it means under pressure. The market can show you a big pile and still be functionally tight if the deliverable slice is small and the owners of eligible metal done a T want to convert it. Why would they not want to? Because conversion is a choice, and choices get expensive when everyone starts smelling scarcity. You can't bully owners of metal into making it deliverable. You can only offer a price or create enough stress that they decide the risk of holding it is lower than the premium they can extract by waiting. That's the mechanism. And it's exactly why a COMEX crisis never announces itself with a siren. It whispers through spreads. But that's not the part that matters. The spreads are the heartbeat. When physical tightens, the first place you see it isn't always the outright price print. It's the relationship between nearby contracts and deferred contracts, and the cost to carry metal from now into the future. In a comfortable market, the curve tends to price in storage, financing, and convenience. In a stressed market, you can see backwardation. Near-term pricing that is stronger than the back end, because immediate availability becomes more valuable than future promises. And when backwardation shows up persistently in something like silver, it's not just a cute chart pattern. It's a signal that someone is paying up for now And paying up for now is what short sellers fear the most because it compresses time. If you're short, time is your friend. If you're long and you need delivery, time is the enemy. The spread is where those incentives collide. And that's where the real pressure starts. There's a second spread that matters even more, and it is one of those plumbing terms that sounds niche until it becomes the entire story. Exchange for physical, or EFP. When you see stress between different hubs, like New York futures versus London spot, the EFP can widen or flip in ways that tell you metal is being pulled, not just traded. You don't have to become a spread trader to understand what it forces participants to do. If spot is scarce in one place and paper is abundant in another, arbitrage tries to bridge the gap. But arbitrage in metals is not like arbitrage in a stock, where you click a button and risk is gone. It involves financing, vault availability, bars of specific size, transport, insurance, and the willingness of someone to actually part with metal. When the arbitrage gets wide and stays wide, it's telling you the bottleneck is not an idea, it's a constraint. The next detail is what flips the whole setup. People assume high price fixes supply. In silver, supply is stubborn. A lot of global silver production is a byproduct of other metals: copper, lead, zinc. That means you're done to get a clean surge of new silver output just because silver got expensive. You'd need base metal economics to cooperate, mines to expand, processing to scale, and that takes time measured in years, not weeks. Recycling helps at the margin, but recycling is also capacity limited and price sensitive in messy ways. Consumers don a tea instantly dump silver into the market because price is high, and industrial scrap isn't infinite. Refining and logistics can be bottlenecks too, and when physical availability is constrained, the price can rise while the market is still tight. Because the problem is not the headline price, it's the timeline and the form factor of the metal that's actually needed. So what does that mean this week, right now, today? It means the market can remain structurally stressed even if price chops around violently. And it will chop. The market will try to shake you out. Price can whip around hard even if the thesis is correct, because volatility itself becomes a tool. And that's not a motivational quote. It's literally how the market clears. Volatility forces position reduction. It forces margin calls. It changes option hedging. It triggers risk committees. It scares weak hands out of physical and scares leveraged longs out of paper. And the people who need metal love volatility because it can flush out supply without having to pay up as much. That's the game. Now let's talk about the COMEX crisis phrase without getting goofy. A crisis in this context doesn't mean the exchange disappears. It means the market structure experiences stress, tight deliverable supply relative to paper claims, higher cost to borrow, physical, more aggressive spread behavior, and a greater likelihood that price discovery is being driven by who can source metal on the timeline rather than who has the best macro hot take. In past stress events, you can see patterns. Registered inventory is trending down, delivery demand rising, and then a moment where participants start treating delivery like an option they might actually exercise. That's when the tone changes, because as long as everyone believes futures are just a financial instrument, the system is stable. When enough people treat futures as a pipeline to metal, stability gets tested, and that's where the real pressure starts. Here's the mechanism that turns stress into a vertical move, and it's the one skeptics always underestimate. Short covering mechanics plus margin pressure. Shorts don't cover because they feel guilty. They cover because their risk limits and collateral requirements change. When volatility rises, the margin required to hold a short can go up, and the mark-to-market losses can stack quickly. If you're short a futures contract and price moves against you, you post more collateral. If price keeps moving and volatility spikes, you post more. If liquidity thins, you post more because slippage risk rises. If your risk manager sees a market shifting from mean reverting to trending, your risk budget shrinks. At some point, you're not choosing to stay short. You're negotiating with a machine that only speaks one language. Reduce exposure. And when shorts reduce exposure, they buy. In a tight market, buying moves price. Higher price triggers more margin stress triggers more buying. That reflexivity is how squeezes go from manageable to violent without warning. And that's not the part that matters. The part that matters is how options can pour gasoline on that fire even when the fundamental story is unchanged. If the market has a concentration of call options at certain strikes, especially round numbers, dealers who sold those calls often hedge dynamically. When price rises toward those strikes, the delta of the options increases, meaning the hedges need to increase. If dealers are short gamma, they're forced to buy more as price rises and sell as price falls, which amplifies moves. In a calm market, gamma effects are background noise. In a fast market, gamma becomes a steering wheel. Price can get magnetized to a strike where open interest is heavy, and if it pushes through, hedging can flip into a feedback loop. This is why silver can go from creeping to air pocket behavior. It's not that everyone woke up and decided $100 is the new normal. It's that the hedging flows can become one-way traffic for a window of time. The calendar is the catalyst here too, because option expirations, monthly settlement dynamics, and roll periods create moments where positioning has to be adjusted whether people feel ready or not. The calendar doesn't care about your narrative. It forces transactions. And that's where the real pressure starts. Now let ES proof stack this in a way that doesn't require you to trust a single data point. You want layers. Layer 1 is term structure and spreads. When the front end stays tight relative to the back end, it tells you immediate demand is winning. Layer 2 is inventory behavior, specifically the distinction between eligible and registered. If the deliverable pool is not expanding even as price rises, that tells you owners are not eager to make metal available on the exchange's terms. That's a behavioral signal. Layer 3 is ETF and ETP behavior. When investors funnel money into silver-linked products, those vehicles often need to source metal through authorized participants and custody arrangements. That can pull physical from the ecosystem, especially when flows are persistent. If you've seen a surge in silver investment demand lately, that's not just chart cosplay, that's a real claim on metal, and it matters most when the system is already tight. Layer 4 is retail and wholesale premiums. When the spot price is doing one thing, but coins, and bars are hard to source without paying up, or delivery times stretch, that SA street level symptom. It's not perfect data, but it's an on-the-ground indicator of friction. Layer 5 is global price dislocation and arbitrage stress. When one region's spot market behaves differently from another's, it's not mysterious manipulation. It's usually logistics and financing getting stressed. Layer 6 is industrial behavior. When price rises too far, some industrial buyers try to thrift, substitute, or delay purchases, which can cap demand. But when industrial supply chains are tight, delaying can create procurement panic. People either slow down or they rush. And the next detail is what flips the whole setup. Both of those behaviors can be bullish in the short term. If they slow down, it can create a pullback. If they rush to lock supply, it can spike the front end and spreads. Either way, volatility increases, and volatility is a catalyst for forced flows. So what does the everyone is watching the headline, but the signal is somewhere else version of this look like in real time? It looks like the headline's screaming record high, while the spreads quietly stay stressed. It looks like pundits saying, this is just retail speculation, while the physical ecosystem is showing friction and the deliverable pool is not responding like it should if this were purely a paper mania. It looks like price pulling back sharply on a scary red candle. So the crowd declares the squeeze is over, and then the next session, it reclaims the level effortlessly because the underlying need didn't go away. This is why I keep saying you have to separate trend signal from noise. Trend signal is persistent tightness in the plumbing, front-end strength, reluctance to make metal deliverable, persistent investment flows, and recurring premiums. Noise is intraday drama, social media narratives, and one-off liquidation days that happen because somebody got margin called or a fund de-risked into month end. The market will try to make you associate noise with truth right when the setup is most asymmetric, and that's where the real pressure starts. Now you also need to hear the counterpoints because the fastest way to get wrecked in silver is to believe one story so hard that you ignore how the market can punish you even if the big picture is right. Counterpoint 1, at high enough prices, industrial demand can soften. Fabricators can try substitution, efficiency, or redesign, and that can cap the rate of demand growth. Counterpoint 2, if the macro backdrop shifts, say the dollar suddenly strengthens, hard real rates spike, or risk assets get hit in a way that forces broad liquidation. Silver can fall even in a structurally tight environment because paper positioning unwinds faster than physical can respond. Counterpoint 3, the exchange and the ecosystem can adapt. Higher prices can coax supply out, financing terms can change, and sometimes the crisis narrative gets ahead of what actually breaks. Counterpoint 4, the market can deliberately weaponize volatility. If enough speculators pile into the same trade with leverage, the path becomes fragile. You can get sharp downdrafts that shake confidence, and then the move resumes later. That's why timing and sizing matter more here than being right. No guaranteed returns, no clean staircase, just probabilities and risk management. And that's not the part that matters. The part that matters is what to watch next so you're not trading your emotions. So here's the clean 2 scenario lens. Because if you can name the scenarios, you stop getting hypnotized by every candle. Scenario 1 is the controlled pullback and retest. In this scenario, silver pulls back from the mid-90s area, maybe even wicks lower, because the market needs to digest gains and flush leverage. The key is what happens on the retest. Does it find buyers quickly? Does it reclaim broken resistance as support? And do spreads stay relatively tight? A controlled pullback with a fast reclaim often sets up the next leg higher because it resets positioning without resolving the underlying constraint. Scenario 2 is the continuation squeeze and gap risk. In this scenario, silver doesn't give you the clean retest. It grinds, then jumps, often on a thin liquidity session, a calendar-driven event, or a hedging wave that hits at the same time as a physical bid. You can wake up to a gap. You can see intraday ranges that feel unreal. That scenario is where people blow up chasing because it looks like free money right until it isn't. The difference between those scenarios is not your opinion, it's what the plumbing prints. In scenario 1, you tend to see volatility with stabilization and then a base forming. In scenario 2, you see repeated strong closes, front-end tightness refusing to relax, and a sense that dips are being bought mechanically, not emotionally. And the next detail is what flips the whole setup. Those scenarios can alternate. You can get a squeeze, then a violent flush, then another squeeze. The market is not obligated to be neat. Now let's talk levels without pretending we have a crystal ball. In a fast market, round numbers matter because humans and options markets both cluster around them. If silver is pressing into the mid-90s and flirting with the psychological gravity of $100, the question isn't, will it hit $100? The question is, what happens near $100 if it gets there? Tease, because if that level is loaded with options and positioning, the first tag can cause a violent reaction either way. It can trigger profit taking and pinning, or it can trigger a hedging wave that blasts through and forces rehedging higher. This is why you don't just watch price, you watch behavior around the level. Does price get rejected and stay rejected, or does it dip and snap back? Does volume expand on the move up and shrink on pullbacks, or does it reverse? Do spreads ease as price rises, suggesting supply is coming out, or do spreads stay stressed, suggesting the market is paying up for immediacy? And that's where the real pressure starts. Here's the next week checklist I promised, and I'm going to keep it brutally practical. 1. Watch the front end of the curve and any sign of persistent tightness. If nearby strength refuses to fade, that's a stress signal. 2. Watch any credible indications that deliverable availability isn't expanding. You don't need perfect daily numbers, you need the trend and the behavior. 3. Watch ETF flow tone and the broader investment bid. Persistent inflows are not the only driver, but they can deepen tightness at the margin, and margins matter when the system is already strained. 4. Watch physical market chatter. The way you'd watch weather when you're sailing. Premiums, delays, sudden out-of-stock notices, or unusual widening between quoted spot and what you can actually source. 5. Watch macro catalysts that can punch the market in the face. Rates, currency jolts, geopolitical flare-ups, and risk-off liquidation waves. These can create both opportunity and pain. 6. Watch options gravity into key strikes, especially if price is hovering near round numbers because gamma can turn a slow grind into a sprint. If those signals line up, you're not guessing anymore, you're observing pressure. Now, what would weaken or invalidate the thesis? This is important because this is where trust lives. If spreads normalize cleanly and stay normalized while price remains elevated, that suggests supply is being coaxed out and the system is digesting stress. If deliverable availability expands materially and consistently, that reduces the odds of an acute squeeze. If investment flows reverse hard and stay reversed, that can relieve the bid side. If industrial demand visibly collapses faster than investment demand can replace it, that can cap the move. And if macro conditions tighten aggressively, think a sharp, sustained surge in real rates or a severe liquidity event, silver can suffer even if the physical story remains tight, because paper unwinds faster than physical. In other words, your invalidation isn't one tick level, it's the plumbing relaxing. Because if the plumbing relaxes, price discovery can cool. But if the plumbing stays stressed, the market can't unsee it. And that's not the part that matters. The part that matters is how you behave inside the volatility. Here's your psychology shield. Because this market is going to try to manipulate your emotions, and it will do it using very predictable tricks. Trick 1, it will make you feel stupid for not chasing when it's ripping, and then punish you for chasing by snapping down. Trick 2, it will print a brutal red candle on a day when the news sounds scary, so you associate down with danger, even if nothing structural changed. Trick 3, it will rally in a way that feels too fast to buy responsibly, so you either over-leverage or you freeze. Trick 4, it will flood your feed with absolute statements. It's over. It's just getting started. This is manipulation. This is fundamentals. So you stop thinking in probabilities. The antidote is boring but powerful. Separate time horizons. If you're trying to capture a multi-week structural move, don't let a one-day liquidation candle rewrite your thesis. If you're trading short-term, don't pretend you're an investor when the position goes against you. Define what you are. Define what signal you're following. Define what invalidates it. And most importantly, size so you can survive the noise. Because the market will use volatility against you. It always does. And that's where the real pressure starts. If you want to be finance literate about this and not just emotionally reactive, think of it like this. Silver's trend signal is tightness and forced behavior. Silver's noise is the theatrics around it. Trend signal is when dips get absorbed quickly, when front-end stress persists, when the deliverable story doesn't relax. Noise is when price whips on a headline or a broad de-risking wave. Your job isn't to predict every tick. It's to position around the higher probability structure and protect yourself from the parts you can need a T control. And speaking of what comes next, the next week or two is where this gets especially interesting because calendar pressure tends to concentrate. Roll dynamics, delivery windows, and option cycles can compress decisions into short timeframes. Liquidity can thin around key dates, and thin liquidity is where gaps are born. If silver keeps pressing higher into those windows, the odds of a reflexive move increase. If it pulls back into them, but the plumbing stays tight, you can get a slingshot. Either way, the market is being forced to reveal whether this is just froth or a structural repricing. And here's the quiet warning. Even if you're right, the market can still hurt you if you let it dictate your timing with fear. That's why we keep the two scenario lens, controlled pullback and retest, or continuation squeeze and gap risk. If you see the controlled retest, you want to see stabilization and reclaim behavior. If you see the continuation squeeze, you want to respect gap risk and not pretend you can outsmart a gamma-driven move with tight stops. It's not about bravery, it's about respecting structure. Now, I want to tie this back to the title S core claim. Silver prices set to skyrocket as COMEX faces crisis, without turning it into a cartoon. Skyrocket in markets doesn't mean a straight line. It means the distribution of possible outcomes shifts upward and the tails get fatter. When the system is tight and the calendar forces action, the tail outcomes expand. You get days that feel impossible in normal regimes. You get levels that get crossed faster than people can update their mental models. You get liquidity vacuums where price jumps not because value changed, but because available liquidity disappeared. That's what crisis looks like in a market structure sense. Not collapse, but stress that distorts price discovery and forces behavior. The hidden detail, registered versus eligible, deliverable versus merely present, matters because it asks the difference between there is silver and there is silver you can actually take now under the rules. And when that difference becomes salient, spreads and hedging flows do the heavy lifting. But that's not the part that matters. The part that matters is the one metric I want you to watch that will keep you sane when the feed goes insane. Watch the stress where it actually prints so, which is the front end and the availability signal, not the loudest headline. When you see persistent near-term tightness and reluctance to release deliverable metal, that's the market telling you the bid is not purely speculative. When you see that tightness ease and stay eased, that's the market telling you the constraint is relaxing. Everything else is theater layered on top. If you're the kind of person who doesn't want to be spoon-fed a narrative and you'd rather understand the plumbing, you're already ahead of 95% of the crowd. And that's the quiet community here. People who watch incentives, structure, and constraints, not just candles. If you want to stick with that crowd, keep your eyes on the checklist, keep your emotions out of your sizing, and treat volatility as information, not insult. Silver can do violent things in both directions and still be in the same structural story. Don't let the market trick you into confusing pain with invalidation. Remember, the trend signal is the plumbing, the noise is the drama, and the calendar is the catalyst. And if silver starts pushing through those psychological levels, with spreads refusing to relax, the market doesn't get to pretend it as normal anymore, because once that line breaks, the market can't unsee it, and the next forced buyer is already in motion.